I'm Blain Moats with LattaHarris CPA firm here in central eastern Iowa. Been practicing since 1988 in public accounting and many facets. As time's gone by, we've kind of refined ourselves into a rural ag county seat type presentation. So we are seeing a lot of the issues that your organization is trying to promote and face day to day. I do have a couple PowerPoints I'll bring up here. Let's see. Are you able to see my screen? I've got kind of a hierarchy chart. Our firm is based out of 5 eastern central Iowa county seat towns. We have about 55 professionals in a wide range of areas of expertise and years of service. So just to show a little bit of the critical mass that we do support as a firm. Our office is probably 3rd in rank size and number of staff members as such in our size of organization. So just a quick overview on that. See if I can split my screen here just to kind of browse through the PowerPoint presentation. I tried to look at kind of the stuff that we see day to day. Again, we're a CPA firm working at times on these transition issues. It's not our day-to-day focus that other special professionals might be working into. So as you guys know, this process has involved a lot of team members, whether that's family, attorney, accountant, financial advisor, insurance agent, family consultant, or facilitator. And at times we dive deeper into the discounts and valuation analysis. So this transition can happen from any one of these team members. So sometimes it takes a different path and journey to get there. But each one is vitally important. And by the time the complete project's done, we're going to see all these people involved. So again, I tried to look at 3 key areas during operations, some of the stuff that we're seeing as we move into that transition and phase down out of operations. What are some of the accounting and tax matters that seem to surface fairly regularly and either have some high pain tolerance in the tax timing and seem to be a little more sensitive. So simply during the business operating, the investment in fixed assets is also a key process that we see along the way. Most people see and understand the cash method of accounting that is unique in farming and agriculture, that we're able to produce, grow, and reap large benefits into a business. However, we can fall back on a pretty innovative method of just using our checkbook and accounting methods. So at times we're looking to defer income. The farming industry and the elevator method of grain movement allows for installment payments on deferred payment contracts. The crops grown, delivered, priced, checks taken in January of the next year. So we do see that as a day-to-day tool, especially the last few years where prices have been high, farmers motivated to sell out of the field, but are experiencing a higher income threshold. At times, we want to accelerate income, and we've used commodity credit loans supported by the Farm Service Agency, where the farmer is able to take a dollar amount loan against corn or beans and generate a source of income without changing their marketing plan. They're able to treat that as a loan or source of income at the point of taxation. And in recent years, the IRS is allowing the producer to switch that method from year to year under a change in accounting method recognition. So we have quite a bit of flexibility on the income side to accelerate or decelerate income. On the expense side, as most have experienced in the past, prepaying expenses for the following crop year also allows for an investment, a deferral, an offset to some of the high cycle volumes of income being recognized in the ag production. We've had instances where we want to slow down expenses, and there are some provisions. One simple tool we've had is to capitalize repairs and maintenance and depreciate those as opposed to expensing. And that's only presented in unique situations where we find out after the fact that our number's too low. We'd like to utilize the lower tax brackets. So we also see tools in the tax code that allow us to slow down expenses and still achieve somewhat of a targeted goal. Then again, the investment in capital improvements and depreciation. We have our general guided regulations through the IRS under Code 167. And everybody's familiar with Section 179 and the significant increase in thresholds that's presented over the last few years, as high as $1,160,000 for 2023. We also have a similar depreciation code under 168 that allows the bonus depreciation on assets with class lives of 20 years or less. That also conveys to the somewhat non-active producer. Most likely we see that with landlords incurring tile expense, which is a deemed 15-year asset life, and they're still able to take the full first year expense on that. As the tax law stands today, that provision is scheduled to phase out over 5 years and will be at 20% in its final year of 2026, unless we experience some changes in tax law legislation. So that kind of gets us just through the operations, and that's really not the focus of your organization, is getting into that transition phase. But I guess I'd briefly open up if there's any questions on the current operations or day-to-day. Again, we are trying to capture the cash method of accounting. We find a lot of comfort in trying to keep income somewhat constant from year to year, and that is, again, managing the timing of income and expenses, trying to get a measure or pulse on carryovers, primarily grain inventories that are building from year to year, along with any accelerated expenses, just to see how big of a deferral that's rolling forward. We run into instances where farmers are downsizing or lose production acres and have carryover income and have unexpected consequences. Up until the last few years, farmers still were carrying a fairly large line of credit balance, and a lot of that carryover income went to pay that off and left the producer with the tax liability. But just if there's any quick questions on operations or productions, or I'll kind of shift into where the the bigger issues kind of arise. Okay, not hearing any. We look at typically the assets are the area that are generating the point of taxation. So we have 4 primary asset classes in ordinary inventory producing. We have livestock that has a combination of an inventory and an asset as they are purchased and depreciated. We move into the larger significant areas for most of our producers with equipment, and then trying to figure out the ultimate use of the land, whether that's leasing it or selling it. And then each one of these possibly is tied upstream into some type of entity structure. So we do have a wide variety of corporate, S-corporate, and LLC structures that have a vast difference in liquidation matters and when the point of taxation kind of comes to place. So again, looking at the grain inventory as the operation either downsizes or ceases to exist, we see the deferred grain payment sales as a still significant way to manage our timing of income. We do start to experience a higher recognition of income as that process takes place. For quite a few years, the IRS has allowed an income averaging technique reported on IRS Schedule J that allows the farmer to continually look back 3 years from the current year to see if there are tax brackets that have been unused due to high fluctuations in taxable income. So that does allow the farmer to stay in what we'd like to stay in the 22 to 24% tax bracket. The next significant jump goes to 32, and that, along with the self-employment tax that is 15.3% on the first $140,000, starts to get into some pretty significant effective tax rates as we jump into that arena. So the Schedule J does help for a couple of those transition years and try and keep us at some point in the lower third tax brackets of something less or equal to the 24% tax rate. We have another unique accounting change. The IRS does allow changes of accounting from what we generally see as the cash method of accounting. In unique situations, we've looked to spread income out under switching to the accrual or production method. And the IRS allows the taxpayer to make an election to spread that deferred income out over a 4-year period. So we've had some instances where we see the retirement coming, it being successful and long-term into that next transition. And we want to try and iron that income out for one reason or another. The IRS would allow that to be spread out over a 4-year period rather than taking a 1-year hit. So we see a lot of difficulty in making decisions when that final year comes and there's a full year crop, a full line of machinery, and then we're faced with the task of trying to collect cash rent on our farmland that we presumably retain forever. And so those 3 income sources build up into a high compression and makes it really difficult to make good business decisions when the tax amount gets in front of us. So again, there's the ability to time that out, rolling into retirement with primarily our grain grain production income. I'll mention this a couple times. The charitable remainder trust, we're seeing a few of those come back again this year, but honestly, in 35 years, I've only had one, and I don't know whether it's just our area, if it's just still the delayed transition of farmers getting, completely out of the business. We will see some farmers possibly going to crop share versus cash rent to allow for some expense management along with their business operations. So,
Blaine,
excuse me here.
could
Yes.
I interrupt you for a second? Your slides aren't transitioning with you as you talk down through the list.
Okay. Let me
We still see the word outline. So
let me see if I can get rid of one of those. Sorry about that. You still see a slide?
I see you right now.
Okay. Let me reverse engineer that quick. Okay, is the slide back up?
Yeah, now it looks more like a slideshow.
Okay, sorry about that. I'm trying to split screen and then so we could kind of see through the outline. So okay, so yeah, we just kind of get through the grain inventory in those transition years. If at all possible, trying to avoid the triple hit with grain, machinery, and trying to at best timely receive cash rent off of our land retention. So breeding livestock is not something we run here into central Iowa. We don't see that many producers that have equity. The hog operations are typically custom feed and modest to small cattle operations, but cattle in the regard to the breeding livestock, we see purchased heifers, cows bred for a period of time. Some are there at retirement along with possibly the calf inventory. So the purchased livestock that have been depreciated are basically sold as ordinary income. We're not able to sell those on an installment contract and delay the reporting of income. It's triggered at the point of sale, whether that's in a cash or installment. And I'll mention that again too. It's similar with machinery. That's really a high compression area. If the breeding livestock, the cows were raised into a specialty herd over a period of time and managing that, the disposition of those would be somewhat similar to land that we would be able to recognize a capital gain, which generates a preferred tax rate on the income and possibly allows for installment delayed sales. And some states also allow incentives in the agricultural capital gain disposition. So again, we're aware of it. We just don't experience that much on the livestock side of it. Now the machinery and the special purpose ag buildings. So we do have a fair amount of hog feeding facilities, fewer cattle hoop barns and other confinement type areas. The equipment is a little more obvious. It's personal property, eligible for fast, high depreciation write-offs, and conversely on the backside, subject to immediate gain recognition on a cash or installment sale. So we are challenged trying to move that along without accelerating taxes. There's really no magic formula for this. A lot of it depends on if the equipment's transitioning to a family member or to a third party, on how well we're willing to extend terms, provisions, and arrangements to still stay within the tax law. Any type of lease to own, discount purchase price at the back end of the obligation is going to be disguised as a sale, and any agreement will basically trigger the recognition of that term at the front end. We've seen variations of short-term leases, 1 to 2 years, based off of some economic value of the machinery pool. As the equipment turns over or is traded in, we see that the tenant leasing needing to purchase that to gain title and roll that into the next piece of equipment. That does shrink the asset base, hopefully re-indexes the lease amount. So between the two parties, over that extended 7 to 10 year period, hopefully they're able to achieve some economic common ground. Family member, possibly a little easier. We may see some discounted lease amounts. We coupled with actually gifting title to that piece of equipment. I know we've had concerns with next generation producers incurring short-term leases and not able to acquire some type of equity component. We would see the elder generation willing to make a gift as those lease payments are made to try and transfer some ownership and identifiable equity. And again, at the end of the day, hopefully being somewhat close to what they were shooting for and staying within the tax laws. This isn't as much taxation we see in some of the piecemealing out of the farm enterprise, some motivation to move machinery and land into 2 separate holding companies, LLCs, partnerships, possibly to help manage operations separate from the real estate, also combined with on and off farm heirs to try and create some identity of long-term ownership and possibly managing the estate to the fair and equal concept that is discussed and presented in those scenarios. Again, in the equipment arena, along with the grain inventory, there could be an opportunity for a charitable remainder trust to stack assets in there, make a immediate disposition, and then take a series of payments over a period of time that complies with the charitable remainder trust rules to spread the income out. On the grain inventory side, it also allows for the recharacterization of that income not subject to the self-employment tax. So that can present a fairly large windfall in recognition of those assets at the end of the operations. Each trust has a formula for payout along with the remainder to charity. The uni trust also allows for multiple funding and contributions. So we see one on the horizon in our office at this time where the grain's been produced, carried over into 2023. There was no existing sales contracts. That grain has to be basically clear titled and can't be subject or encumbered by any type of pre-sales arrangements to allow the trust to have outright title, but at some near time period, we're going to have machinery available and up for auction, and that may not come in for another 3 or 4 months later. And this percentage payout trust or uni trust allows for contributions to happen at different periods of time. So a little bit of flexibility there in funding and still managing the best economic value and managing under that tax deferral. Land being the highest value and most sensitive in most environments. Again, short of land and tile improvements that have been aggressively depreciated under the tax law, allows for capital gain treatment upon disposition. Land allows the opportunity for the producer to shift into a semi-retired mode as crop share, use income deferrals and expense timing to manage the income. And those leases under a written arrangement, the tenant does the work, the landlord crop shares, those sources of income are not subject to self-employment tax. So again, takes that extra 15% cost off of the production side. So does have a little curb appeal if the producer's still willing to manage the crop risk and expense side of it. So most land's been held for extensive period of time unless it's been acquired through an estate or step-up base. Do we see a combination of holding the land till death and trying to minimize any in-between tax on holding that? Again, separating land from machinery, depending on the overall gross estate. We still see opportunities in trying to gift or transfer fractional interest to help transfer a bigger dollar, either under the annual gift tax exemption or taking a bigger bite out of the current exemption. So uniquely in kind of preparing for this and reaching out with Heather and some other presenters on this area, your organization has a member that is primarily focused in transition with Mike Downey. He's based out of Eastern Iowa. We've had some interaction with them. They support a company that is primarily facilitating the discussions with the family prior to the accountant or attorney or other people becoming involved in that. So they've started some innovative companies trying to match landlords that aren't able to find the tenant that they desire in that next transition for one reason or another. Possibly the land mass that the retiree has is more than the one tenant can manage in the farm requirements for operation and financing. So we see some variations in there besides the tax, and transition is just trying to find a tenancy. So I'll give Mike some credit at the end of the presentation, along with some of the other resources that we see, or just blogs and reading material that come across us fairly day to day. But I just threw this kind of in the tail end. There's still, if we see the transition resulting in the producer leaving their personal residence and acreage, that the IRS allows for a gain exclusion on residents owned 2 of the last 5 years for those people that are either moving to town or experiencing some other type of movement on that. So I'll kind of keep moving. We're still in the transition, but now we look upward and see that these inventories, equipment, livestock, and possibly land or tied up into some type of entity structure. A little before my time, we still had the opportunity for corporations to liquidate at their original cost basis. The tax law changed, and for all my practicing years, the assets come back out of a C or S corporation at fair market value. And that's whether you're selling to a third party or you liquidate the entity, and shareholders take those assets back into their personal ownership. And again, with any land holding for extensive period of time, the amount of appreciation makes that very difficult to experience the C corporate tax, which today is a flat 21%. Prior to that was 35% on federal tax only. So we almost found it preclusive to try and liquidate a C corp back into any type of LLC or individual enterprise. So in contrast, we have partnerships and LLCs that own assets, and to a large extent, the dissolution, the redivision, split up, spin off of those entities are going to allow the retention to still be at the carrying cost basis as it sat inside the entity. So again, we have challenges when we get upstream into those entities on whether we can manage the tax load, or do we have to wait for a lifetime event or a death to help allow for some adjustments of that. C corporations, we've had maybe 5 times in my history in 35 years where we see a corporation in the latter third of its maturity accumulating some cash and equity, still motivated to buy land in the combined individual corporate enterprise, where we see the C corporation buying the land under a term interest of 12 to 15 years. At the end of that term, the property reverts to the remainder interest, the individual, and as a opportunity to help bleed those entities down kind of at the end of the operating period. So again, maybe just focusing on land that are tied up in some of these entities. My brief discussion with Heather yesterday on what type of experiences they're seeing on a situation by situation basis. We still have 10 to 15% of our business entities were structured in the 70s, primarily for estate tax management purposes, in a way to devalue the land in a corporate structure that had the land trapped at the point the taxation was at fair market value for removing those assets. So as we see today, the ability to get step-up basis at death in a corporate setting only adjusts the stock value to the decedent. It doesn't step inside the entity structure and change the carrying costs of that. So we have a potential perfect storm in favor of the taxpayer to convert to an S corp if a series of other compliance rules are met, carry that real estate and land to a point of death to get a step-up basis in the individual stockholder, the beneficiaries. And then, similar to a mutual fund, we would have that asset liquidated to the then shareholders with a gain recognition that increases their stock basis in somewhat of a doubling effect to allow them to then at liquidation weigh the value of the assets, the land that was distributed, to the cumulative cost basis of the stock, which included the basis at death equal to the land and the gain recognition. So we end up with a capital loss on the stock, and we end up with a capital gain on the land that offset themselves in the crossover period. But in order to get there, and we're holding this land during some of the twilight years, we are not producing, we're renting the land. The IRS is going to test that converted corporation and see that if there's any prior earnings from the C corporate years that they feel were earned under favorable pretense. They're going to make the shareholders disperse that accumulation out in the form of a dividend, which prior to capital gains rates and qualified dividends were almost unheard of and preclusive. However, when we weigh that with the consequences of never being able to liquidate the C corporation and transferring the headache and burden to the next generation, we do see some willingness to accept that interim tax. The IRS wants to roll that entity back to day one as if it was S corp since inception and kind of get a fresh start. So where that accumulation is significant, we've maybe tried to attack that over a 5-year period, declare dividends, whether they're cash or in kind. The IRS allows for a deemed dividend adjustment, which is income recognition without the payment of the cash. So we're able to still accomplish the long-term goal, and generally with a time period, if we're able to pace that, it seems like it's generally agreeable, even though we are voluntarily paying some capital gain rate tax on that qualified dividend. So it's kind of the best we can get with the scenarios presented. Again, with corporate transition, if we're focusing only on the estate tax and not outliving the ultimate liquidation of land, we would see some other opportunities with discounts on the closely held entities. Again, that's where a lot of the make or break is. We do have, the post-death situation. We are in a fairly high climate of estate exemption to sunset in 2025. I guess during the lifetime or at death, the basis of the assets acquired by gift are the same as the donor, so there's no step up versus the back end and getting the cost adjustment. At the time of the estate, we could see some assets that don't qualify for step up, and that would be the producer that has sold grain under deferred payment contract. So they've transferred title and priced it, died before the collection of that source of income. That is not eligible for the cost basis and is taxed still at ordinary income. Occasionally, we have some installment sales where the then retired producer is willing to sell some land, property, or other assets to the buyer relative under installment sale. Those arrangements carried at death, the income deferral on that is still subject to tax to the beneficiaries of that contract. So that's about my 45-minute quick speech on the 3 areas: operations, transition. Again, we are primarily reacting to situations as they present them, rather than, outwardly seeking new arrangements. We're pretty much dealing with our in-house group of clients. So our direction's coming from a different, motivation as much as maybe some of the other key players in that. But yeah, along this line, we have questions on when can I draw Social Security benefits? The full retirement age of 67 pretty much precludes a producer that still wants to say someone active in being able to generate farm income as a proprietor, as their income limits are fairly diminished. In the transition years, the larger transactions push people's adjusted gross income, where they're going to experience higher Medicare premiums. Land sale and some of these peak years are going to pop up and hit some of those thresholds. Yeah, we have some other incentives, some beginning farmer loans, credits. In these transition years, we have income being qualified for the business income deduction, which is a 20% for the most part of operating, and ordinary income recognition provides a little bit of offset for some of the tax rate effects. And as I mentioned earlier, just in the locale we live, we're utilizing our state universities for resources similar to Heather's. For many years, we've followed Paul Neifer. We had a 10-year stint where our firm was actually part of their former Clifton Gunderson, so we've had a long standing following with them. Roger McGowan, formerly with Iowa State, now Washburn University, somebody we follow on a weekly basis. And I mentioned Mike Downey as one of your network participants, is also a resource that we would fall back to in one time or another. So that gets me quite a ways into it, Heather. If anybody had questions or.
Yeah. So at this time, if anyone wants to type questions into the chat box or unmute and ask questions directly, now is your time to see what else you can find out from Blain or get some clarification if you had questions that way. I do want to let everyone know while you're thinking of your questions or typing them in, I have put the link for the CEU credits into the chat box if anyone on needs those. So if you're a certified coordinator, please make sure you hit that. It will be available for the rest of the day, and then I'll try to get all that recorded. So any questions coming through from the thoughts that you came up with there? So can you see that one?
Yeah. Yeah. So I think what we're seeing kind of in conjunction with the farm facilitators and the concept of fair, equal, and division of assets and the on-farm air is typically one trying to separate the identity of those, and maybe as much in the land holding companies. The presumption is the land would be held forever, even into the next generation. And that entity, that LLC, could have restrictions put on it besides what the initial funder, mom and dad, put in there, that the LLC has restrictions on redemption. So when mom and dad die, that we don't see an immediate knee-jerk reaction and want their divisible share of that entity. We possibly would have language in there that would allow for a discount in the first couple of years, the twilight years of death, that would have a higher discount rate on the buyout than maybe in the 5th to 7th year, and possibly that the then inherited member subject to some type of self-financing arrangement so that the longevity and the on-farm heir that's also part of that landholding company is not forced to find immediate financing for a fairly large, expensive transaction. So it'd be less for income tax and maybe more for asset management.
Thanks, Colette. Any other questions? Oh, there's another one coming in about working with financial advisors.
Yeah. So retirement plans is another place to offset income through structure. The most advantageous, but probably the most complicated and expensive, are the defined benefit plans, where we go through the complex formula of a deemed retirement age. Typically, they're a expected 5-year program, allows for some large catch-up provisions. The challenge we have is the cost of the plan. From what we've seen, is anywhere from $1,500 to $2,500 to set it up. It would cost, from what we've seen, that much a year to manage it for actuarial and other, and then to close the plan, we're seeing another $1,500 to $2,500. So I'm clearly not opposed to that. It's trying to find the balance of to manage the plan and who's going to do it. So what we've seen, the defined benefit plans are somewhat created by the plan administrator under as much understand as they can get into that tax code. And so, yes, we've seen that. It's trying to find the other pieces of the puzzle. The dropping the money into the fund is not a problem. It's the plan administration cost. So the farmer getting into the qualified plan is tied to their compensation. So again, if we're in somewhat of a corporate structure and farmer taking de minimis wages, would then probably have to ramp their compensation somewhere in the 150 to 200,000 range. Again, which in these phase out years, and we're dealing with $1.5 million to $2 million of carryover crop and $2 million worth of machinery, and still a land component of it, is not necessarily excessive, but we'd like to think that those 5 years worth of compensation could, given what the actuary and the age of the participant, could be 75 to 125,000. We would clearly rely on the financial advisory and the plan administrator to give us those funding contributions. They would give us the salaries that would then generate the contribution that we would take back into the enterprise, and then find the best way to accomplish that. Yep. And then I see another comment using the taxpayer spouse combination to get a doubling effect. And now we're seeing some relaxing rules with the Secure Act going into 2023, that those primary contributions and catch-ups are getting into some areas that would also allow for some jump ups into that. So yes, that would be a good way to steer some money out of the ag component of it and create future liquidity and get some of the tax deferral adjustment. So I would clearly agree on that. So land should never go into a C corporation, and we would not see that in the last 30 years, but there still are too many, even if there's one, with land trapped into that structure. So again, we have to look at some succession, some time to possibly clean up that entity, and a death. We also have some C corporations that in those high estate tax years had common and preferred stock, and mom and dad gave the common stock to the children, which was deemed to be the equity, and the mom and dad kept the preferred stock, which was somewhat of a estate freeze, still allowed for them to maintain control and voting rights, but that did not carry the equity with it. We've got 180 degrees since that time frame, and now possibly would not want that common stock or equity in the next generation if we're going to try and go through the step up basis and the S corp liquidation to get the land out of there. So I've had discussions. I've not personally experienced where we've had a reversed gift in moving that common stock back to mom and dad several years, hopefully prior to their death, to help manage that. And when we get that accomplished, the S corporation is not allowed to have common and preferred stock. So we got to get rid of that component out of the equity side of that through whatever is available in the corporate operating and structure. So it can get messy. It takes a time to manage the current taxation. And again, if we end up trying to do some reverse gifts on the common stock. So that time will allow some of that to get there, but it is a challenge as well. So.
Okay, so there was some good chat over some of that retirement stuff that you've filled in and then covered with the C Corp. Anybody else have any questions? We technically have until 1 o'clock blocked off, but Blain has said if he's still answering questions, he'd stick around for a little bit. So if you have a couple more questions, please feel free to ask them. Otherwise, make sure you go and record your credits if you need the credits from today's session. Otherwise, we will say thanks for joining us and we'll go from there. One more question just came in there, Blain. Conservation easements.
I've maybe 35 years, maybe it's, are we talking a donation of conservation easements? Can we clarify that a little bit further? Or making a sale of ag conservation easements. So I get the topic right. We've seen easements placed where the land will never be developed, and that, in fact, permanent easement is achieved to get a charitable donation. But okay, I've not seen that. Reduces the value of the land and keeps it available for agriculture. No. We've seen some wetlands and some other compensation for permanent easements of wetland and some wildlife habitat. The landowner keeps the land but is not able to use it for agriculture. It would be basically for recreation purposes. So that would be very state specific. I'd be surprised if the state of Iowa would have any motivation at this time to step down that path, but that definitely, I think we're, you know, at the end of the day, the land is the near and dear, and trying to preserve it again, we'd like to think that's going to be retained for forever and multi-generations, but I know just some of the statistics that was shared with me from, again, Mike Downey's, group, and this is pretty widespread, is the concentration of land in those, 55 to 60 is, 80% or more. Some statistics he shared with me that 80% of the land operated in Iowa is not by the owner, it's by a tenant or some other conduit. So lots of challenges. And again, taking it into the second or third generation, we have people that have never been involved in the farm or lived on it, are difficultly motivated to stay, as an owner with a 3 to 5% return on a highly appreciated asset. So
South Dakota started a land conservation, an ag land conservation program just in the last, as soon as you say a year, you should probably add 5 or 6 because time flies. 5 or 6, maybe 7 years, so that it is designated ag and you can't build a shopping mall on it, some of those types of things. So to keep agriculture ground agriculture. So it's pretty interesting how those work in some of the, I know Colorado's got some, East Coast has a bunch, so kind of a whole different twist on some of those types of things that they're playing with. Okay, Kansas and Missouri have several. So
that's good. That's good.
Anybody else have questions that they would like answered before we sign off for the day?
Or if you get something beyond this or something, Heather, reach out to me again and I can dive a little deeper. Again, we kind of react after the fact. It's hard to just on a platform catch everything, but again, there's still quite a few tools out there, and I think just planning will allow for a lot of accomplishment. So
You bet. That planning is huge. Okay, well, would you mind if I share the slides that you shared with me with the group?
absolutely. Yep.
Okay,
They're,
so those that registered, I will email you a hard copy of the slides out, and you'll have those available. Again, the presentation will be posted to the IFTN webpage at a future date. You won't get CEU credits for that viewing, but if you go today here and hit the button on that link that's up further in the chat, make sure you get that done. If you're interested in becoming a member of IFTN, we always encourage that. We will start the new year in June. So if you want to become a member, June is a great time to get that done and taken care of. You do get a price break on conferences like this for being a member and also being one of our certified coordinators. So seeing no additional questions come in, I think, Blain, I'll say thank you, and we will wrap this thing up.
Thanks for the invite.
All right. You have a great day, and great day to all of you out there way across this country, it looks like we had on today. So we'll see you next time.